Here's a question almost nobody can answer correctly on the first try. Who actually owns the Federal Reserve, the institution that controls U.S. interest rates, decides how much money exists, and moves markets with a single sentence in a press conference? Most people guess, the government. That's wrong. The Federal Reserve is a strange hybrid, created by an act of Congress, but structurally owned by private commercial banks. Those banks hold stock in their regional Federal Reserve banks. They receive dividends. They help select regional Fed presidents, some of the most powerful economic decision-makers in the country, without a single public vote involved. And here's a second fact that surprises people even more: when your bank approves you for a loan, it isn't handing you money that already existed in some vault. In that moment, it's creating brand new money, out of nothing, with a few keystrokes. This isn't a conspiracy theory. It's literally how the Bank of England, in an official 2014 paper, described modern banking. So if the government doesn't fully control it, and banks are quietly creating most of the money supply themselves, the real question is, who is actually in charge here? Why this matters now? This isn't an abstract academic question. It shapes your rent, your grocery bill, your mortgage rate, and increasingly, geopolitics itself. When the Federal Reserve raises interest rates, it isn't just a U.S. decision, it reshapes currency values and debt costs for nearly every country on Earth, because so much global trade and lending runs through the dollar. And in the last few years, the world watched something even more revealing. When the US and its allies cut Russia off from the SWIFT international payment system in 2022, it became public knowledge, in the most direct way possible, that a handful of institutions effectively control whether a country can participate in the global financial system at all. Money isn't just a tool for buying things anymore. It's a lever of power. And most people have no idea whose hand is actually on it. How the control actually works, the three layers. Let's break this into three real layers of control, because who controls money isn't one answer. It's a stack. Layer 1, the central bank. The Federal Reserve sets the base interest rate and decides how much money to inject or remove from the economy through tools like buying government bonds. It's technically independent from the President and Congress on a day-to-day basis, designed that way specifically so politicians couldn't print money to win elections. The Fed chair is nominated by the President and confirmed by the Senate, but once in place, operates with enormous independence for a set term. Layer 2, commercial banks. Here's the part school never really explains clearly. Roughly 90 to 95% of the money circulating in the economy isn't physical cash printed by the government. It exists purely as digital numbers created by commercial banks when they issue loans. Every mortgage, every business loan, every car loan, new money, created on the spot, backed by the borrower's promise to pay it back with interest. The Fed sets the rules and the base rate. But the actual volume of money flowing through the economy is largely decided, loan by loan, inside thousands of private banks making profit-driven lending decisions. Layer 3, the global system. Above both of these sits an international layer most people never think about, institutions like the Bank for International Settlements in Switzerland, which coordinates rules between the world's central banks, and SWIFT, the messaging network that essentially allows global banks to talk to each other and move money across borders. None of these are elected. None of them answer to voters in any country. And together, they form the plumbing that decides whether money can move at all, anywhere in the world. The hidden math nobody explains. Here's where this gets uncomfortable. Because most money is created by private banks through lending, and because banks lend based on what's profitable rather than what's socially necessary, the money supply doesn't grow evenly. It flows toward mortgages, corporate buyouts, and speculative assets, because that's where the returns are, and it flows away from things like small business lending in struggling regions, because the risk-adjusted returns look worse on a spreadsheet. This means the amount of money in the world isn't some neutral, government-managed number. It's the accumulated result of millions of private lending decisions, each one made to maximize a bank's own profit. And the dollar's global dominance adds another hidden layer. Roughly 88% of global currency trades involve the US dollar on one side of the transaction, and the majority of international trade is invoiced in dollars, even trade that has nothing to do with America. That means U.S. monetary policy, decisions made by unelected officials in Washington, optimizing primarily for the American economy, ripple out and reshape borrowing costs, inflation, and currency stability in countries that never had any input into that decision at all. This is what economists sometimes call the exorbitant privilege of controlling the world's reserve currency. It's a privilege for America. For most other countries, it's closer to being along for a ride they didn't get to vote on. Hype versus reality, the democratic money illusion. The comforting story most people grow up believing is that money is a public good, managed transparently by elected governments for the benefit of citizens. The reality is closer to this. Money creation runs primarily through private profit-driven institutions, monetary policy runs through a technically independent central bank designed specifically to be insulated from voters, and global money movement runs through international institutions that answer to no electorate at all. Here's the irony worth sitting with. Governments are constantly blamed, in headlines and in public frustration, for inflation, for interest rates, for financial crises. But a huge share of the actual decision-making machinery sits one or two steps removed from anyone voters can actually hold accountable at the ballot box. This doesn't mean it's a secret cabal running things in a smoke-filled room. It's something more mundane, and in some ways more unsettling, a system built, piece by piece, over more than a century, where accountability quietly got distributed across institutions specifically designed to be hard to directly control. Some of that insulation was intentional, and arguably necessary, to stop short-term political pressure from wrecking long-term economic stability. But it also means the government controls money is a much shakier claim than most people assume. Zooming out, the bigger picture. Now widen the lens even further. Because SWIFT and dollar clearing systems sit at the center of global finance, they've become a genuine geopolitical weapon. Cutting a country off from these systems, as happened with Russia, and Iran before it, can cripple an economy without firing a single shot. That's an extraordinary amount of power concentrated in institutions most citizens, in any country, couldn't name if asked. This is exactly why countries like China and Russia have spent the last decade building alternative payment systems, and why there's growing global discussion about de-dollarization, reducing dependence on a system controlled by decisions made in Washington and a handful of allied capitals. At the same time, central banks worldwide, including the Fed, are exploring central bank digital currencies, or CBDCs. Depending on how they're designed, these could either make money creation more transparent and directly accountable to the public, or concentrate even more control into a single, centralized digital system. Which direction it goes isn't decided yet. It's actively being shaped right now, largely outside public attention. The closing thought. So who really controls the world's money? Not one person. Not one government. It's a layered system, a technically independent central bank, thousands of profit-driven private banks creating most of the actual money supply, and a handful of international institutions controlling whether that money can move across borders at all. Almost none of it sits in the hands of anyone directly accountable to an ordinary voter. Which leaves behind a question worth sitting with the next time you hear a headline blaming the government for the economy. If most of the actual power over money was deliberately built to sit just outside democratic reach, what does it actually mean, anymore, to say the public is in control of its own money,